Hello and welcome to the first in a series of global fixed income strategy insights that we hope to share through the course of this year. My name is Luke Copley. I'm a product specialist for the Allianz core fixed income team. And in today's session, I'm focusing on our Allianz Global Opportunistic Bond strategy. The key message for this year for 2021 is that we expect to tilt portfolios away from spread and income themes. By the end of last year, that did represent around 50% of active risk in our portfolios. And we will be looking to redistribute this risk towards active currency management, active duration strategies, and by continuing to focus on yield curve views as well. So coming into this year, we have had some dry powder and we're looking for opportunities to increase portfolio risk. And already in January, we've executed several re-risking themes across the portfolio. Adding back to our US yield curve steepener, this follows the news of the Democrats taking the US Senate. So if there is speculation on more aggressive fiscal easing and an acceleration in the US growth rebound, it can certainly have a more reflationary impact on bond markets and thereby cause longer dated yields to underperform. We are also looking at the strength in the commodity market and looking at ways to engage with that theme as well. And we will also look at those oil sensitive emerging market names as well. Yields will ultimately have a ceiling because of several secular structural themes in the market. Some of the long-term disinflation trends, some of the demographic challenges. And so if we see, for example, 10-year US Treasuries increase further towards 1.25%, we would be inclined to add duration at those levels, given the relatively attractive valuation versus those longer-term headwinds to rising yields. And that allows us to remain engaged with taking duration risk in the strategy. On the spread side, in terms of credit positioning and including emerging markets, while many investment-grade rated emerging market sovereigns are now trading back through the pre-COVID spread level, so the valuation compression has allowed us to take profits, we actually remain relatively cautious on re-engaging with this part of the market. We prefer to rotate that risk into higher yielding EM sovereign assets, where we do see more scope for recovery and better value. We expect the credit market to ultimately look past rising infection rates in the near term and focus more on the distribution of vaccines and how the economic recovery can take hold. And of course, we have a number of supportive technical factors for credit markets in terms of demand and central bank purchases. Despite the compression in valuations and the rally back, particularly in investment grade, we still see some opportunities, particularly in those more COVID-sensitive sectors, such as transportation, leisure, and we're engaging in those industries. We also do see some value in higher yielding bonds in both corporates and emerging markets that have lagged the recovery through 2020 and should give us some scope for allocating to spread through the course of this year. I will hopefully be back in touch with a further update as we progress through this quarter. Until then, stay safe and thank you for listening.